Welcome to CoreLogic's update on housing market conditions for May 2019, brought to you by onthehouse.com.au. Australian dwelling values fell 0.5% last month as the pace of home value declines continued to ease after moving through a recent low point in December last year, when national dwelling values were falling at a much faster rate. The latest housing figures take national housing values 7.2% lower over the past 12 months to be down 7.9% since peaking in September 2017. The slowing in the rate of decline is attributable to an easing in the market downturn across Sydney and Melbourne, where an improving trend in the rate of decline has been evident over the past 3 months. In December last year, Sydney dwelling values were down 1.8%, with the pace of falls progressively moderating back to a month-on-month decline of just 0.7% in April. Similarly, Melbourne values were down 1.5% in December, with the rate of decline slowing to 0.6% in April. Other property market insights are supporting a subtle improvement in housing market conditions, including a rise in mortgage-related valuations activity, as indicated by CoreLogic's platform data, an improvement in the ABS household finance data for February, and the fact that auction clearance rates are holding around the mid-50% range across the major auction markets. While none of these indicators could be described as strong, the current trend of the data implies that housing market conditions may have moved through the worst of the downturn. Although the national rate of decline has improved, the geographical scope of falling values has broadened in April. Dwelling values fell across every capital city apart from Canberra, while across the regional areas of Tasmania, Victoria and South Australia also avoided a fall. The broad-based nature of weaker housing market conditions highlights that tighter credit conditions are having a dampening effect across all markets. Annually, national dwelling values were down 7.2%. That's the largest decline since the 12 months ending February 2009, which was associated with the global financial crisis. Focusing on the Sydney market, dwelling values were down by 0.7% over the month. Although the month-to-month falls remained substantial, this was the smallest decline in 6 months, continuing a trend that has seen the rate of decline improving since the beginning of 2019. Since peaking, Sydney values have reduced by almost 15%, providing a substantial improvement to housing affordability and pushing rental yields higher. Listing numbers across the Sydney marketplace remain high, providing buyers with a wide range of choice and a strong negotiation position. Vendors, on the other hand, are continuing to face a challenging selling environment, which has led to a substantial reduction in new listings being added to the market. The Melbourne housing market recorded a 0.6% fall in housing values in April, taking the annual rate of decline into double-digit territory for the first time in the history of our index, which commenced back in 1980. Although dwelling values are continuing to trend lower, the 0.6% fall in April was the smallest monthly decline since June last year, highlighting an easing in the pace of value falls during 2019. The local unit market has recorded much smaller falls relative to detached housing, with unit values down 4.1% over the past year, compared with a 12.6% drop in house values. The underperformance of detached housing is likely related to the more expensive pricing relative to units, especially considering the surge in first home buyer numbers who are generally price sensitive. Brisbane housing values have been trending lower over the past 5 months, driving values 1.9% lower over the past 12 months. The downtrend in housing values comes despite rising demand from higher population growth, relatively affordable housing prices and steady economic conditions. Considering the strong market fundamentals, we aren't expecting a material decline in Brisbane dwelling values, although tight credit conditions are clearly having a dampening effect on the level of buyer activity. At 4.4% for houses and 5.4% for units, Brisbane rental yields are amongst the highest of the major capitals, reflecting a 1.5% rise in rental rates over the past year against a backdrop of lower values. Adelaide housing values have slipped slightly lower over 3 of the past 4 months, dragging the 3-month trend into negative territory and reducing the annual gain in values to just 0.3%. Along with Canberra and Hobart, Adelaide is one of only 3 capital cities to record an annual rise in housing values. Houses and units are recording a similar performance, with values across both product types rising by 0.3% over the year. Local rental markets remain relatively sluggish, with weekly rents up only 1.4% over the past 12 months. With housing values reasonably firm and rents slowly rising, Adelaide rental yields are trending higher, rising from 4.38% a year ago to 4.43% in April. Housing values continue to trend lower across Perth, slipping by 0.4% in April, which was the smallest monthly decline in 12 months. Since peaking in 2014, Perth dwelling values are down 18.4%. The cumulative decline in dwelling values has been much more substantial across the most affordable quarter of Perth's housing market, where values have dropped by 24.8%, compared with a 13.6% decline across the most expensive quarter of the market. With values recording such a substantial and prolonged downturn, the median house value across Perth is now the lowest of any capital city at just $463,000. The annual trend in capital gains across the Hobart housing market has been losing steam since peaking at 13.2% back in March 2018, winding back to just 3.8% over the 12 months ending April. The monthly index showed Hobart values dropped 0.9% in April, which was the first material decline in dwelling values since 2014. The recent drop in housing values marks a turning point at what has been by far the strongest capital city housing market in the country. The past 5 years has seen Hobart housing values surge 35% higher, providing a great deal of wealth for homeowners, but also creating substantial affordability challenges for prospective buyers. Darwin dwelling values have been continuing to trend lower, with the market down 1.2% in April and 7.1% lower over the past 12 months. The latest fall takes Darwin housing values to a cumulative decline of 28.1%, and housing values are now back to levels last seen in mid-2007. The unit market has shown a much weaker performance relative to houses, with values down 13% over the year compared with a 3.8% fall in house values. On a more positive note, Darwin rental yields are substantially higher than any other capital city, tracking at 6.0% on average. Canberra was the only capital city housing market to record a gain in housing values over the month of April. Values edged 0.4% higher over the month to be 2.5% higher over the year. Although values are still rising, the annual trend rate of growth has eased from a recent peak of 7.3% at the end of 2017. The resilience to a downturn can be attributed to a strong detached housing sector, where values are up 3.5% over the past year, helping to offset a 0.8% slip in unit values over the same time frame. Higher wages growth and healthier housing affordability relative to most cities are other factors helping to support the local market. Overall, we're seeing further evidence that the worst of the housing market conditions might now be behind us. Values are still broadly declining, however the pace of decline has moderated since December last year, and there are some tentative signs that credit flows have improved, albeit from a low base. Considering that tighter credit conditions were one of the primary catalysts for the housing market downturn, any sign that credit availability is improving would certainly be a welcome outcome for the housing market. According to the Australian Bureau of Statistics, lending to households for dwellings, excluding refinancing, was up 2.7% on a seasonally adjusted basis in February. Additionally, a rise in CoreLogic valuation platform activity throughout March hinted a further improvement in housing finance numbers, which will likely be reported by the ABS in their next release. Another indicator of a subtle improvement in the housing market can be seen in auction clearance rates. They're holding around the mid to low 50% range, albeit on low volumes relative to a year ago. The correlation between auction results and housing market conditions is strongest in Melbourne and Sydney, where auctions still comprise a much larger proportion of selling activity. While the mid-50% clearance rate doesn't suggest housing prices are set to bounce back, it does imply a closer fit between buyer and seller expectations, and the improved auction success rate supports the reduced rate of decline in housing values across Sydney and Melbourne. Although housing values aren't falling as rapidly as they were previously, we're still seeing values trending lower across most regions of Australia, and any recovery in dwelling values is likely to be a long-term outlook. Listing numbers remain elevated across all capital city markets, providing buyers with a wide range of choice, plenty of bargaining power, and little in the way of urgency. Capital city listings haven't been this high at this time of the year since 2012. Despite total listing numbers remaining elevated, fresh listings being added to the marketplace across the combined capitals are down 31% relative to the same time last year, indicating extremely low vendor confidence. The lower number of new listings entering the marketplace shows there is minimal sign of panicked selling. Prospective vendors seem to be comfortable in delaying their listing until selling conditions improve. The prospects for lower interest rate is another factor that could support an improvement in housing market activity later this year. While borrowers are still facing tougher serviceability assessments and scrutiny around their overall debt levels relative to their income and their expenses, lower mortgage rates will certainly be a net positive for the housing market. Mortgage rates are already around the lowest level they've been since the 1960s, and any further reduction is likely to be well received by the market. On the other hand, the federal election outcome could deliver a wild card for the housing market. A change of government could see taxation policies relative to the housing market rolled back or removed, which would be an overall negative for investment demand. According to the ABS, investors currently comprise 27% of the value of mortgage demand, excluding refis, down from 43% back in 2015 and now well below the decade average of 34%. A further reduction in investment activity without a commensurate rise in owner-occupier activity would likely place further downwards pressure on housing prices, especially across the heavily supplied, high-density sector of the market. With so many uncertainties in the marketplace, it's more important than ever to stay up to date with the latest trends and market information. Make sure you're keeping up to date with the latest facts and figures via the research pages at www.corelogic.com.au.